It's 11:47 p.m. on a Sunday. You're at the kitchen table, laptop open, spreadsheet pulled up, the one you've updated a dozen times, but never actually committed to. You're staring at the mortgage balance on your rental property. You bought it 3 years ago. Tenants are decent. Rent covers the payment, mostly. And there's this number at the top of the spreadsheet, the payoff date, and it's 14 years away. You run the math again, not because you forgot it, but because you're hoping something changes. It doesn't. And somewhere between that number and the third tab you opened, the one about refinancing, about 1031 exchanges, about accelerated payoff calculators, you start wondering if you made a mistake. If everyone who talked you into this was wrong, if the neighbor down the street who bought 2 rentals last year is actually a genius or just going to be underwater in 18 months, nothing went wrong tonight. You're just doing what every landlord does in year 3, running the math, doubting the math, running it again. Here's what I want to show you. The math you're running right now is the wrong math. Not wrong because you made an error, wrong because it's measuring the distance to the finish line instead of what happens when you cross it. My name is Elena, and I spend way too much time thinking about why the first paid-off rental changes everything. Not just the cash flow, but the psychological operating system of how you make every financial decision after that. If you've ever wondered whether holding a rental long-term is actually worth it, or just a slow grind that maybe pays off someday, subscribe and hit the like button, because that question is exactly what this video answers. Before we get into it, not a financial advisor. This isn't financial advice. This is math and psychology, and you can decide what to do with it. Here's the promise. By the end, you will understand why the first paid-off rental functions differently than everything else in your financial life, not just as an asset, but as a decision-making machine. And we're going to get there through 2 characters, some math that most landlords never run, and one psychological trap that derails almost every first-time investor before they ever get there. Let's start with the scoreboard most landlords are using. Because if you've owned a rental for 1, 2, or 5 years, I'd bet everything that the number you check most often is cash flow. Monthly. How much comes in? How much goes out? What's left? Here's what most first-time landlords don't realize about that number. It is one of the least useful numbers in the entire investment. The trap here is the spreadsheet itself. It feels like clarity. You built it, you maintain it, it updates automatically, and it tells you, almost to the dollar, whether this thing is working. The problem is that the spreadsheet is measuring what it can see. Rent minus mortgage, revenue minus expenses, monthly profit, maybe a cap rate. What the spreadsheet cannot see is the payoff date's neighborhood, what lives just on the other side of that 14-year number. Let me give you 2 people. Marcus is 34. He bought a rental property in 2021, a 3-bedroom, 2-bath, 9 minutes from a mid-sized state university. Purchase price was $218,000. He put 20% down, financed the rest at a 3.8% interest rate, 30-year note. His tenant pays $1,550 a month. After taxes, insurance, and the occasional repair, his actual monthly cash flow hovers around $210. Some months it's $310. Some months it's negative because the water heater went out. Derek is 34, same year, same market, bought a nearly identical property 2 streets over. Same price, same interest rate, same tenant rent, same $210 a month in cash flow, give or take. Same starting point, same spreadsheet, same number that barely moves. Watch what happens in year 14. Here's the number most landlords skip, not the monthly cash flow. The monthly cash flow after the mortgage disappears. Marcus's mortgage payment, principal and interest, is $814 a month. He's been running a cash flow of $210. Fine, manageable, building equity, he tells himself. The day that mortgage is paid off, something happens that doesn't feel like a financial event, but is actually one of the most significant ones in his entire life. $814 a month comes back, every month, permanently. His cash flow goes from $210 to roughly $1,024 overnight. Let me say that again. $1,240 a month in cash flow from one property that he already owns. Sit with that. That's not the compound interest pitch. That's not the if you invested that money hypothetical. That is real money that was always his. It was just servicing a debt. When the debt ends, the money doesn't stop coming. It just stops leaving. Now run Marcus's actual numbers across the next 20 years after payoff. $10, $24 a month, 12 months a year, with conservative rent increases of 2.5% annually, which is below the historical average, means Marcus collects just over $314,000 in gross rental income in the 20 years after his mortgage is gone. The property, which he bought for $218,000, now has a market value closer to $390,000, assuming a 3% annual appreciation rate, also below historical average for most U.S. markets. He didn't buy a $218,000 investment. He bought a $700,000 outcome and paid for it over 30 years. That's not a lot of money. That's a retirement asset. Here's where Derek's story goes differently, and here's the trap, the one that almost nobody sees coming, because it doesn't look like a mistake when you're making it. Derek's property hits year 5. He's been grinding the same $210 a month cash flow, the same spreadsheet anxiety, the same Sunday night math, and someone shows him a deal. A duplex? Better cash flow on paper. Cap rate looks better. If he does a cash-out refinance on his current rental, pulls out $48,000 in equity, he can fund the down payment. This is where almost every first-time investor exits the payoff track. The trap disguises itself as scaling. It looks like strategy. It sounds like leveraging your equity to grow your portfolio. And that argument is not wrong in isolation. More units can mean more income. Diversification has real value. The real estate world will tell you, loudly, that idle equity is wasted equity. But here's what Derek just did to his math. He reset the clock on the first property. He was 9 years from having a property with $1,024 a month in free cash flow. Now he's 29 years away. The payoff date he was closing in on evaporated, and the new duplex, with its own repairs, its own tenant headaches, its own vacancy risk, now has to work perfectly just to get back to where he was. The market contributed nothing to that decision. The bank encouraged it enthusiastically. Lenders love borrowers who have equity and want to use it. Here's what most people at year 5 don't realize. The equity in your first rental is the most dangerous asset you own, because it's also the most liquid. You can pull it out at any time, which means the temptation to pull it out never goes away. The best thing you can do with equity in a property you intend to hold? Leave it alone. Let the payoff date get closer. Let the mortgage balance shrink. Let the clock run. Here is the math that Derek's advisor never ran for him. If Derek had left the equity in place and let both properties pay off on their natural schedules, his original rental in 9 years, and a hypothetical second property purchased with saved cash 3 years later, he would have had 2 paid-off properties generating a combined $2,100 a month in free cash flow by age 52. Instead, Derek at 52 has 3 properties, 2 of which are refinanced, combined gross income of $4,400 a month, combined debt service of $3,600, net cash flow of $800, and 0 margin for a bad year. The spreadsheet that shows $4,400 in revenue looks better than the one that shows $2,100. But the $2,100 is unconditional. The $4,800 in revenue requires everything to work. 1 extended vacancy, 1 major repair on the wrong month, 1 bad tenant who stops paying and takes 4 months to remove. And the whole model goes into a cash call. Congratulations, you financed a liability and called it a portfolio. That's not a knock on Derek as a person. The system is designed to make his choice feel like the smart one. The bank profits from it. The real estate coach who sold him the course profits from it. The property management company profits from it. The only person who doesn't profit from Derek staying leveraged forever is Derek. Here's where I need you to stay with me, because the second half of this video is where the math starts doing something genuinely strange. We've been talking about what happens when the mortgage is gone, but there's a layer underneath that, a psychological shift that changes how you make every financial decision after your first rental is paid off. And most people who get there are surprised by it, because it doesn't feel like what they expected. A study published in the Journal of Personality and Social Psychology found that our financial risk tolerance isn't fixed. It shifts dramatically based on whether we feel we have a stable, unconditional income floor beneath us. Not savings, not a net worth figure. Income. Recurring, predictable, baseline income that exists regardless of whether we show up to work. That stopped me cold when I read it, because what it means, applied to Marcus's situation, is this. The moment his rental is paid off and $1,024 a month starts arriving without a debt attached to it, his entire relationship with financial risk changes. That's not $1,024 a month in extra money. That's $1,024 a month in unconditional income. It pays regardless of his job status. It pays if the market crashes. It pays if his employer downsizes. It doesn't require his presence, his performance review, or his manager's mood. Most people underestimate the value of their first paid-off rental by calculating it as income. It's not just income. It's a floor, and a floor changes what you're willing to build on top of it. Marcus, at 14 years after he bought that property, is now someone who can take risks he couldn't before. He can leave a stable job with a toxic manager. He can start a business with a longer runway. He can go part-time while his kids are young. He can weather a prolonged vacancy without selling the property in a panic. He can say no to things that used to require a yes. The financial term for this is margin. The human term for this is freedom. They are the same thing, but the spreadsheet only captures one of them. Derek, at 48, is still managing the math on 3 properties, none of which are paid off. His gross income on paper looks better than Marcus's. His net worth on paper might even be higher, but he doesn't have a floor. He has a stack of leveraged bets, each one dependent on the other, any one of which could go sideways in a bad rental market, and take the rest with it. And here is the detail that doesn't show up on any spreadsheet Derek has ever built. Marcus is sleeping better, not because he has more money, because he has less exposure. The psychological cost of carrying debt on an income-producing property is real, and it compounds across every other financial decision you make. When you are always one bad month away from a cash call, you don't take risks, you don't start businesses, you don't leave bad jobs, you stay in the lane because the lane is paying the mortgages. Charlie Munger said it simply, the first rule of compounding is to never interrupt it unnecessarily. Most landlords read that as investment advice. It is also life advice. The thing you are trying to protect is not just your rate of return. It is your ability to make decisions freely, without debt, as a co-signer on every choice. The borrowing got him bigger numbers. The payoff would have given him something the bigger numbers can't buy. Ronald Reed was a gas station attendant and a janitor in Vermont. He wore a used coat held together with a safety pin. He drove a used car. When he died in 2014, at the age of 92, he left an $8 million estate, almost entirely to his local library and hospital. He didn't build it through leverage or cash-out refinances or portfolio expansion. He bought stocks and held them. He never sold. He let time do what time does to assets that are allowed to compound without being interrupted. The lesson isn't buy stocks instead of rentals. The lesson is the strategy that works is almost always the least exciting one while you're doing it. And it almost always requires not touching the thing that is quietly accumulating. Your paid-off rental is your stack of never-sold shares. Its power is not in what you do with it. Its power is in what you don't do with it. The boring choice isn't the consolation prize. It is the strategy. Let me build this out with a real household so the math feels concrete. The Garcias, combined household income of $118,000 a year. Above median, they take home about $7,600 a month after taxes. They own a primary residence. They bought a rental property 7 years ago, same profile as Marcus, 3-bedroom, 30-year mortgage, $810 a month in debt service, tenants paying $1,575. Their cash flow right now is about $225 a month after all expenses. They've been told repeatedly, by podcasts, by real estate influencers, by well-meaning friends, that they need to be scaling, buying their second property, pulling equity, growing the portfolio. These are not irresponsible people. They did everything they were supposed to do. Here's what their spreadsheet doesn't show. In 8 more years, that mortgage is gone. At current rent, with 2.5% annual increases, their cash flow goes from $225 a month to just over $1,100 a month. In the 15 years after that, they collect approximately $247,000 in net rent with no debt service. The property, which they bought for $210,000, will be worth somewhere between $330,000 and $400,000 in a market with any real population base. They will own an asset free and clear that generates $1,100 a month in income and is worth nearly twice what they paid for it. That's it. That's the entire strategy. They bought a property, they didn't sell it, they didn't refinance it, they didn't use it as a piggy bank when the rates looked good. They let the mortgage die. The gap didn't open in year 15. It opened in year 7 when they chose not to do the cash-out refi. And in year 4 when they didn't sell because the market looked hot. And in year 2 when they didn't bail after the bad tenant. 100 small decisions, all of them, at the time, feeling like patience rather than strategy. Here's what this means in practice, in order, with numbers. First, find your actual payoff date. Not the one on the original amortization table, the real one, accounting for every payment you've made. Put that date somewhere you can see it. Give it a name. That date is not the finish line. It is where the race actually starts. Second, calculate your post-payoff cash flow. Take your current gross rent, subtract taxes, insurance, and average monthly maintenance. Industry standard is 1% of property value annually, divided by 12. Then add back your full principal and interest payment. That number is what your property produces when the bank is no longer a partner. Third, protect that payoff date. The number one threat to your payoff trajectory isn't vacancy. It isn't a bad tenant. It's a cash-out refinance that feels like growth. Before you pull equity for anything, ask one question. Does this trade the payoff date for something worth trading it for? The answer is sometimes yes, but it is almost always answered too quickly, with too much optimism about what the new deal will do. Fourth, let the floor build first. You are allowed to get one property paid off before you buy the second. There is no rule that says you must be scaling while you're still building. You can choose not to play the leverage game. There is no trophy for the most mortgages. The only scoreboard that actually matters is the one nobody can see. Marcus, at 55, has a property that has been paid off for 7 years. He's been collecting around $1,200 a month from it, and with rent increases, closer to $1,280 by now. He doesn't talk about it at dinner parties. He doesn't post about it. The property sits. The income arrives. Last year, Marcus left a company he'd worked at for 11 years. Not because he was fired, because a manager he didn't respect kept asking him to do things that felt wrong. And for the first time in his adult life, he had the margin to say no. He took 4 months off. He consulted. He thought. He started something small that might become something real. The rental made that possible. Not by being spectacular. It was one property, paid off, generating a little over $1,000 a month. But that $1,000 a month was the difference between a choice and a requirement. And the thing it gives him, the thing the spreadsheet never showed him when he was doing Sunday night math at year 3, isn't the money. It's that he can make decisions based on what he actually wants rather than what the payment requires. That's what every person who gets there reports. Not that they became rich, not that the cash flow was life-changing in a dramatic way, but that something shifted when they stopped owing money on the thing that generates income. That the psychological weight of the debt, the quiet tax it collected on every career decision, every job change, Every financial risk they considered and backed away from? Lifted. That's what the first paid-off rental actually buys you, not $1,224 a month. A different relationship with every decision you make after that. The gap didn't open at payoff, it opened in 100 small moments across 14 years. Every time you chose not to interrupt the thing that was quietly becoming yours. This is hard to do alone with a YouTube video. Knowing your payoff date and running the post-payoff math is step one. Knowing whether your specific situation, your equity position, your market, your other assets, calls for protecting that date or doing something different with it. That's a different conversation. If you're serious about building your first rental into something that actually pays you back, not just on paper, but in the real way that changes how you live, the link in the bio is the next step. Not for people who are watching videos about real estate investing, for people who are ready to run their specific numbers and make a decision about it. If this landed for you, drop a comment with where you are in the journey. Year 1, Year 5, Year 14. I read all of them. Subscribe for more of this kind of analysis. And I'll see you in the next one.